Welcome to Growth Investing Mastery. Today we're going to be introducing GeneDx, symbol WGS. And as a reminder, this is not investment advice, recommendations, or financial advice. First, let's review the company details for GeneDx. They are a genetic testing company that provides genomic insights, and they use exomes and genomes for sequencing, which diagnoses rare diseases. Exomes are a small part of genomes. It seems like I'm not completely sure on how the technology works, but that's my understanding. And the company was founded in 2000, and they went public about 4 years ago through a SPAC. The company is around 1,000 employees. The headquarters is in Connecticut. They have 141 million of cash, and debt is 116 million. So cash is a little ahead of debt, which is good. The market cap is 2.8 billion. And it's had a big run up, especially today since they reported earnings. The stock's been on a real roller coaster. It got up to $900 a share after the SPAC, and then it basically was abandoned by the market. It got as low as $2 in 2023, and now it's back up to $113. Let's take a look at the numbers for GeneDx. I like to look 5 quarters back so we can see the year-over-year growth rates compared to the current quarter. And 5 quarters ago, they had 57 million of revenue. It then went to 62 million, 71, 77, and 96 million of revenue in this last quarter. The year-over-year growth rate went from -6 to 45%, to 45% again, to 44%, and then to 67% this last quarter. They had originally guided for 80 million in Q4, and then a few weeks ago, they pre-reported that they would get at least 92 million, and surprisingly, it landed at 96 million. And the trend in EBITDA is also very positive. It went from -13 million 5 quarters ago to -8, then to -5, to -2. And this last quarter was positive 14 million of EBITDA. Net income also has a similar trend where it went from -26 million to -20 million to -29 million, and then to -8. And this last quarter was 5 million. And there's a really positive trend in gross margin. You can see it went from 60% to 60 again, 61, 62. And then this last quarter was an absolute blowout, landing at 69. Let's take a look at the narrative or the story for GeneDx. The company says they're in a new phase of growth where they're expanding in the NICU, the pediatric outpatient, adult, and newborn screening. They've done 750,000 clinical exomes and genomes sequenced, and each test adds to the data set, further improving future tests. In the NICU, they're already seeing steady increases in genomic volume quarter over quarter, and they said the newborn screening opportunity is with never seen before scale. The average selling price for the test is $3,500, and that's up significantly from Q3, where the test cost $3,100, and up significantly as well from last year, where the test costs $2,500. In Q3, they raised guidance on revenue, gross margin, and it saw lower cash burn. They recently released a cheek swab for the NICU setting, and they're improving turnaround times on tests where newer tests only take 2 days. 13% of pediatric neurologists use the test, and there's lots of room to expand in the marketplace. Let's continue to look at the narrative for GeneDx. Medicaid approvals are increasing as individual state policies evolve to cover exome and genome testing more broadly. The company sees a future where all newborns are screened genetically, regardless of symptoms or not. And the company is winding down low gross margin tests from their menu, as they call it. That's why Q4 gross margins were up so much. Children are often misdiagnosed 3 times on average when they have a rare disease, and that's if they don't get a genetic test. There's a very large and growing total addressable market. Most insurance companies, whether commercial or Medicaid, are now covering, and there's a growing focus on the NICU segment. Pediatric opportunity is quite large as well. Let's take a look at what GeneDx reported for Q4 results on February 18th. The guide they had previously given at Q3 suggested they would get 80 million of revenue. They pre-announced a few weeks ago they would get at least 92 million of revenue, and they came in at 96 million of revenue today, which is up 67% year over year and 24% quarter over quarter. and the stock shot up almost 45% today. Surprisingly, when they announced the strong result of 92 million or pre-announced it, the stock didn't rally that much. And they had said that exome and genome revenue was 78.8 million. That's up 100% year over year and 31% quarter over quarter. The volume of tests was about 21,000. That's up 32% year over year and 7% quarter over quarter. And as you can see, the volume of tests isn't growing nearly as fast as revenue. That's partly because the average selling price of the test is going up, and they're getting more of those paybacks from insurance and reimbursements. Adjusted gross margin was 70%. That's up 64% from last quarter and up from 56% a year ago. And those are huge step ups in gross margin. Adjusted operating expense was 49 million. That's up only 1% year over year. And full year adjusted operating expense was 185.9 million. And that was somehow down 14% year over year. That's always good when you see revenues going up and operating expenses are staying flat or going down. Adjusted net income was 16.8 million. They had a one-time recovery payment of 6.8 million. And most companies don't report an adjusted net income. The reason healthcare companies do is they have something called true ups where they get reimbursed at different times, and that's why they adjust the number to account for the tests in the quarter. The gross profit was 66.9 million in Q4. That's up 106% year over year and 36% sequentially, which is incredibly strong. There's an accelerated adoption of exome and genome sequencing coverage by state Medicaid programs as well. Let's continue looking at the Q4 results. There were a number of new products released. One of these was called Ultra Rapid Whole Genome Sequencing, which takes only 2 days to give a result. And previously, tests used to take multiple weeks. There's a new telehealth testing pathway, meaning people can get a test through telehealth. And lab optimizations have set up faster turnaround times. I mentioned before there's a new cheek swab for newborns. They've increased yield from tests, meaning less follow-up testing. And there's a new product called GeneDx Discover, which is de-identified data to improve all stages of drug development for other companies. There's lots of ongoing studies and trials they mentioned in the last report, and this helps accelerate market expansion. The company has 80% market share among pediatric genetics experts and 13% pediatric neurologists. Q4 seasonality results from insurance deductibles that reset at the end of the year, and a lot of customers want to have their tests done in Q4 so insurance can fully pay for it. There's an expanding enterprise sales team, and the company said the NICU and pediatrics really going to ramp up in the second half of 2025. Now let's take a look at some potential drawbacks with GeneDx or the bear case, and it's always good to look at what can go wrong with a company. GeneDx had a complex SPAC debut, and the company was originally called Sema4, and then they rebranded. There's also competitors like Natera with symbol NTRA, and they're about 10 times the size of GeneDx. Although their test is a bit more shallow and tests less conditions, it's also in the same space. And Medicaid reimbursement policies could change, especially with the new administration. And shares from the IPO are up from 24.2 million to 27.4 million. It's somewhat reasonable for a healthcare company over a 4-year period, but it's worth keeping an eye on to make sure the share count doesn't go up and the company is a shareholder-friendly company. Finally, let's wrap up with some concluding thoughts for GeneDx. The company has increasing sales which correspond to better profitability across gross margins, net income, and EBITDA. Operating expenses are barely increasing. The product has a compelling value, and it discovers diseases early on, helping improve a newborn's life. The stock was basically left for dead when they had trouble getting traction in the marketplace, but now their product is picking up traction. There's a promising opportunity now as the company gets a foothold in the pediatric and NICU space. I'd love to hear your feedback about the company, and just as a reminder, this is not a recommendation to buy the stock.